Before you buy any stock, there is one question you should always ask. Am I paying a fair price for these earnings? That question is at the heart of stock valuation, and the tool that answers it is the price to earnings, or PE ratio. It is the most widely used valuation metric in the world, used by individual investors, hedge funds, and Wall Street analysts every single day. By the end of this video, you'll know exactly how to use it. PE stands for price to earnings. The formula is simple: share price divided by earnings per share. Let's use Apple as an example. If Apple stock is trading at around $180 and the company earns around $6 per share annually, the PE ratio is 180 divided by 6, which equals 30. A PE of 30 means investors are willing to pay $30 for every $1 of Apple's annual earnings. You can think of it as the market's price tag on the company's profits. The higher the PE, the more expensive the stock is relative to what it earns. Now, what does that number actually mean? A PE below 15 generally suggests the stock may be undervalued, or that the market expects slow or declining growth. This is common in mature, stable industries like utilities or traditional banking. A PE between 15 and 25 is considered fair value for most established companies. The S&P 500 has historically averaged around 15 to 20. A PE between 25 and 40 usually reflects a growth premium. Investors believe the company will grow its earnings fast enough to justify the higher price. This is where risk increases. A PE above 40 is expensive territory. It requires near-perfect execution from the company. If growth disappoints even slightly, the stock can drop sharply. This is common in high-growth technology and during market hype cycles. Let's look at some real examples. Apple trades at a PE of around 28. It is a premium to the market average, but Apple has consistent earnings, enormous cash flow, and a loyal customer base. Many investors consider it fairly valued. Berkshire Hathaway sits around 22, close to historical norms. Warren Buffett's diversified holding company generates reliable earnings across dozens of industries. Tesla trades at a PE of around 60. That is expensive territory. Investors are paying for future growth potential, not current earnings. If Tesla delivers, it is justified. If it doesn't, the stock is vulnerable. Coca-Cola sits around 24, steady and predictable as you'd expect from one of the world's most recognized brands. Amazon trades around 45, reflecting high expectations for continued growth in cloud computing and e-commerce. Note, these are approximate values for illustration purposes only. Always check current figures before making any investment decision. Now let's be honest about what the PE ratio cannot tell you, because this is just as important. First, it is backwards looking. PE uses past earnings. A company with a high historical PE might have a brilliant future that makes the current price perfectly reasonable. Second, industries are different. Technology companies always trade at higher PEs than utilities. Only compare PE ratios within the same sector, not across industries. Third, earnings can be manipulated. Accounting choices affect earnings per share. Always pair your PE analysis with a look at operating cash flow, as we covered in Wednesday's video. Fourth, it ignores debt. Two companies with identical PE ratios but very different debt levels are not equally valued. Debt amplifies both risk and reward. Fifth, growth isn't captured. A PE of 40 might be completely reasonable if earnings are growing at 50% per year. Which brings us to the PEG ratio. The PEG ratio, price earnings to growth, adjusts the PE for the company's growth rate. The formula is simple. PEG equals price to earnings divided by the annual earnings growth rate. A PEG below 1 suggests the stock may be undervalued relative to its growth. You are not paying full price for the growth you are getting. A PEG around 1 means the stock is fairly valued. The price approximately matches the growth rate. A PEG above 2 generally suggests the stock is expensive relative to its growth. This requires strong conviction that the growth rate will accelerate further. The PEG ratio is particularly useful when comparing high-growth companies, where a high PE alone might look alarming, but is actually justified. Here is a practical 5-step process for using PE in your own investing. Step 1, find the PE ratio. Look it up on Yahoo Finance, Google Finance, or your brokerage platform. It is always displayed on the stock summary page. Step 2, compare to sector peers. Apple's PE should be compared to other technology companies, not to oil companies or banks. Industry context is everything. Step 3, compare to the company's own history. Is this stock trading above or below its own average PE over the past 5 to 10 years? History gives useful context. Step 4, check the growth rate. High PE plus high growth might be perfectly reasonable. High PE plus low growth is a warning sign. Step 5. Look at cash flow too. Confirm the earnings are real by comparing the PE to operating cash flow per share. If they diverge significantly, investigate why. 4 things to remember. 1. P equals price divided by earnings. It tells you how much the market pays for each dollar of company earnings. The higher the PE, the higher the price relative to profits. 2. Context is everything. Compare PE within sectors and against historical norms, never in isolation. 3. Growth can justify a premium. A high PE isn't automatically dangerous if earnings are growing fast. The PEG ratio helps you assess this properly. 4. Pair it with PEG. The PEG ratio accounts for growth, giving you a more complete valuation picture than PE alone. Now you can look at any stock and ask the right question. Am I paying a fair price for these earnings? That is what every smart investor does. It doesn't guarantee a good outcome. No single metric does. But it ensures you are thinking about price and value, not just momentum and hype. If this video helped you, please hit like and subscribe. New finance videos every Monday, Wednesday, and Friday. Next Monday, we're starting week 3 with the 50-30-20 budget rule. Does it actually work? Or is it oversimplified? We put the data to the test. See you then.